When I started trading, the excitement blinded me so much that I spent hours looking for the best possible strategy that guaranteed me results. Most of them relied on complex language and multiple indicators. I lost money and slowly my confidence. But as an engineer, I refused to give up. I knew there had to be a way to simplify trading that even a 5-year-old would understand. In this video, I'll be sharing the only A+ strategy that I use in the market. It is simple and repeatable, and all you need is the checklist I'll be sharing in this video along with the live examples so that you can apply it in the market. So what is the main challenge? Number one, growing an account with proper risk management and a simple strategy that works. Risk management is great, but when you have a strategy that you can repeat multiple times and then you're able to then master it, you're able to explain it to somebody else. And that's what this checklist I'm going to be providing later on in this video is going to help you with, so that when you start trading this strategy, you're able to have a checklist in front of you and you're able to then repeat it and master it. And number two, just not knowing which setups are high probability ones. So you don't think of risk management, you just trade it the same way. You don't know how to manage your positions. Risk management is important. Knowing the strategy and knowing how to manage the risk that comes with that strategy is just as important as well. So when it comes to risk management, let's assume you have $1,000 account. For you to get out of a 5% drawdown on a $1,000 account, you need to be able to make 5.26%. That's not that bad. That's not that bad. You just need one winner, one solid winner using this strategy to be able to get out of that. And then it gets tricky when you then hit this 25% drawdown mark. Maybe you had a losing streak or you didn't manage your risk properly. But having a high win rate, and when you manage your risk properly, you can always come out of this type of drawdown. A 25% loss, a 33% winner. You just need two winners or maybe one very solid winner to actually get out of this. When you then hit that 90% mark, it becomes mentally difficult to get out of this drawdown. It would take a miracle to be able to get out of it, luck even, to be able to get out of it. So why am I saying this? We need to be able to understand high probability setups and manage your risk. Risk is important because if you don't trade the strategy well and follow the instructions, this is where you start to take unnecessary, silly losses. Now, what can we trade with this strategy? I primarily trade stocks and options, but it works with other assets. For the sake of this video, I'm going to be explaining how I trade stocks and options. The stocks that you're going to be trading are basically the SPY, the QQQ, Nvidia, Palantir, Intel, and Apple. Why do I mention these names? Because I trade options, and the contracts are affordable when you're trading the 6 names. Whether you have a small account or a big account, they're affordable, and the strategy works very well with them. An example I'm going to be going over are using 2 of the names listed here. Announcement, I'm going to be doing something I have not done yet in my free community. I'm going to be live trading from August 17th to August 31st for completely free. So this is your window to join the community if you haven't. Now let's get right back to the video. So like I said, I trade options, right? If you don't know what options are, I'm going to go over it really quickly. But if you want a detailed video on options, let me know in the comments and I'll be sure to consider it and make it. Or you can join my free community as well. So when you open your broker and you go to what we call the options chain, you would see a table that looks like this. You have calls on your left and you have puts on your right. You buy calls when you think the stock price is going to go higher, and the contract, which we call premiums, would increase as the move happens in your favor. And you buy puts if you think that the price is going to go down, and the premium price, which you see here, would increase in value as it works in your favor. So you end up selling in profit. If you are wrong and you get stopped out, you sell for a loss. And the maximum you can lose when you're trading options is the premium you pay. So this is what we call premium. So for example, on this QQQ chart, and you wanted to buy QQQ calls and you bought the 730 strike price calls because you thought, okay, QQQ will go through 730 and continue going higher, and you bought the calls for $341. Now it looks like it's 3.41, but you need to multiply by 100. You need to multiply by 100 to be able to get the price that actually gets deducted from your balance. So 3.41, it's going to be $341 that you pay. So that's just the basics I've gone over really quickly for the sake of this video. If you want a more detailed video, leave a comment and I will consider it. Now, the simple strategy. What we are going to do, and I'm going to use examples in the charts to go over the strategy in detail so you can follow it, but I'm just going to explain it first and then give you a checklist, and then we go over the examples. Now we're going to mark out 2 important key levels. Once we mark out those 2 important key levels, the next thing we are going to also look for is for 2 specific scenarios to play out. If scenario A plays out, we will move on and then look for a criteria for us to take trades. And if the criteria sets up nicely, all we have to then do is enter the trade, execute, and manage our position. Now, when it comes to the checklist, you want to mark out 2 key levels that I'll be showing you shortly. And then the next question you're going to ask yourself is where could we go next? So you're going to now mark out higher time frame liquidity levels. Once you do that, we would then move on and check for our entry criteria. And then we'll now have our entry for sure, our stop loss, and our exit. So you're going to follow this step every single time. Just watch the examples in details. And if you have any questions, do not hesitate to ask me in the comments or join my free community, and I'll be able to help you out. I'll do my best to help you out and clear up any questions you have. For this example, first thing we're going to do, step 1, is to mark out our key levels that are going to guide this trade. So we're going to mark out the high from the previous day, and we're going to mark out the low as well. We're going to change the color of this low to red just so we can identify it and differentiate the key levels. The reason why we mark these levels is that they are very important liquidity levels that price will gravitate to and it respects. And if price breaks above the previous day's high, there's a chance it would gravitate to the next possible key level. And that's how it works. If price breaks the previous day's low, there's a high chance it will gravitate towards the next key level. Now, we're going to mark out the next set of key levels price could gravitate to, and that would be our potential targets that we want to look for. In this case, we'll mark out this previous high right here, and if price breaks this high as well, where could it go to? We look left, mark out this level here at 730.82, and next we'll mark out its downside scenario as well. If price breaks below the previous day's low, where could it go to? It will go down to this area right here, and it could potentially fill the gap at this level as well. The next level we want to then think about has to do with our criteria for trades. We're going to mark out the previous day's close. So now once we mark out this previous day's close level, we want to just mark it as PDC so that we know that that's the previous day's close. Once we've marked this out, we are going to then go down to the 1 minute time frame, and we're going to wait for the market to open at 9:30, and then we are going to look for a trade. If price stays inside this range, the best thing to do is nothing, because it would be a choppy market. It would not really give you good flowing opportunities. But if price is able to break either above or below, we would have trading opportunities. Now, I'm going to simply play out this tape, and we're going to look for a trading opportunity. Okay, so far still inside the range. Now, one thing we are going to mark out, now that the first 5 minutes has played out, we're going to mark out our opening print. We're going to make sure that it is purple so that we differentiate it as well. And if price breaks above the opening print and holds above that level by the time you're looking for a trade, it's good to look for upside trades. And if price is also above the previous day's close, upside trades should be your main focus. If price breaks below the previous day's close and is also below the opening print, downside trades should be your focus. So now let's continue to play out this tape. Strong bullish candles are forming as we trend up. So this is another good sign that upside trades will be high probability as long as we get out of the previous day's range. You can see that we have broken out of the previous day's high. Strong candles are forming. Now what we want to look for is for price to come down, revisit this area and hold. Because if it does, there's a chance price will continue to move higher. Let's play this out, and we would look for an entry. We don't want to enter just yet because the risk, remember I told you to think about risk. If we're wrong, we want to lose small. It means we need to enter as close to our key level as possible. So we see now we got that pullback in. We want to see if price respects the previous day's high. Okay, we're seeing sellers push price back into the previous day's high, but we want to now see if buyers are able to hold price. So as you can see here, buyers are holding price respectively. Price came down into this area and buyers stepped up. Now, what we are going to do is to look for an entry the moment price breaks above this candle's high, which is 727.75. And what you're going to be looking for in this instance is you're going to be getting 728 or 729 call options. Your stop loss is going to be just a candle closure below your previous day's high. It's a small stop loss, and then you're either going to be looking for a 1:2 like I always preach, but in this instance it's different because of how price action is forming. We can target 1:2, you can take your profit there, but in this instance, because this is such a high probability A+ setup, we want to see if we're able to hold this trade to our targets of 728.54 and 730.82. Like I said, you're going to be looking to take the 728 calls or the 729 strike price call option. You want to go at least 2 days out in terms of contract expiration date at a minimum to give yourself time, especially because you're still learning. You do not want to touch same day expiration option contracts. Give yourself at least 2 days out and you take the 728 or 729 call options. Now we're going to play this out and we're going to see if we end up hitting the targets. So we entered the trade the moment the price broke above that candle's high. And because we see that we hit our targets in just one candle, you can see that there's a lot of strength because of how this candle closed at the highs. A lot of sellers did not challenge this candle and the following candle as well. So we can manage this trade as long as this high right here is respected. We can continue to stay in this trade. This is how you hold your winners longer. Then you play it out and see if you end up hitting your next liquidity level, which is your 730.82, and that's where you want to exit the trade and be done and not overstay your welcome. So let's play this out. You can see that you end up hitting your resistance level of 730.82, and in this instance, because your risk was so small and you just managed the trade, you didn't exit. Maybe you decided, okay, I'm going to hold beyond my 1:2 risk to reward and see if we keep going higher. The reason why we did this again was because of the strength of the candle that hits our target. That candle closed with strength. If you don't understand candlesticks, I can answer your question in the comment section and I will send you a video that you can watch so that you know how to read candlesticks properly, because that would help you to stay in trades and manage your position really well. And if you continue to play out this tape, you can see that price even continue to move higher. So if you wanted to continue to hold this trade, you could, but I advise once price hits your targets, especially if you're trying to build your account, do not overstay your welcome and let greed start to take over. As you scale your account and you're able to leave risk-free runners, then you can allow your trade to continue running and running to capture the extent of the move. All right, in this example, we're just going to follow our steps. We're going to mark out the key important levels, which are the previous day's high, and we're going to make it green. And we're going to mark out the previous day's low, and we're going to make that red. And we are then going to mark out our supporting levels. Where could price gravitate to if it breaks the previous day's low? Where could it go? We're going to mark out this low right here. And we have to be reasonable with where we mark as well, right? We can keep going. We can mark this low as well. So that will be an area, that will be a zone of interest. I don't want to go too further back. We can then look for the upside. If price breaks above, where could it go to next? You can mark out this area and mark out this area as well. Once we've done that, we can also then mark out the level we need for one of our criteria, and that is the previous day's close. So once we mark out the previous day's close, we're going to add a text so we remember previous day's close. We've marked it out. We go down to the 1 minute time frame, wait for the market to open, and we can then look for our trade, which scenario ends up playing out. In this case, even before the market opens, you can see that price is closer to the previous day's low and it's filling it. And one of our criteria is already being met. Like, we're so far away from the previous day's close, so it would most likely be a downside trade. And in that case, what would we be looking for? We'll look for price to break, confirm, and then we'll look for an entry on the retest of this previous day's low area. For downside trades, they happen very fast and your entries need to be a little bit more aggressive because, like they say, staircase up, elevator down. So now let's play this out and we're going to mark out the opening print and make sure our criteria for that is met as well. We're going to mark out the opening print. Here is the opening price, which is also the opening print. Mark it out in purple. In this case, look at how close the previous day's low is to the opening print. What I like to do is to draw out a box that would help me use it as a reference area for my trade, right? I want price to basically respect this box. I don't want price to come and break above and hold above this area. It means that the trade idea would be invalidated. In this case, this will be my area of interest where I want price to come back into and revisit and show me that sellers are in control. What does that look like? Let's play out this tape and I will walk you through how to enter this trade. You can see that initially sellers and buyers are fighting it out. It looks like sellers are more in control because we're seeing price rejection 3 minutes in. Buyers are trying. It's currently balanced. Buyers are still trying. Buyers are trying. but sellers come in strong with this strong strength candle. Look at the context. This strength candle covers 1, 2, 3, 4 candles. So there's a lot of strength. This shows that sellers are truly in control. Now, can they hold it below this our area of interest, this previous day's low? So now we're gonna play out the tape and see if price continues to respect. We get confirmation sellers are indeed present. Sellers are present. Now I want to see if a candle comes back down and closes below this green candle's low, and then I will be able to enter a trade because it's confirmed to me that what our criteria is met. Price is below the opening print and it has retested this area. What we have is what we call confluence right now. We have a lot of reasons to take this downside trade. I'm not giving you perfect examples because in reality, it's not always going to look so clean. That's why I'm showing this example right here. I'm walking you through it so that you understand. I'm not showing you a fine, shiny example that would not be realistic in the everyday market. This is an example where it doesn't look pristine, but it's high probability. So now what would I be looking for? I'll be looking to enter this trade once I see another selling confirmation. I have gotten that. You can enter this trade and you're going to have your stop loss at this point right here, the previous day's low. If a candle comes up and closes above the previous day's low like this, you have a candle that closes, then the trade is invalidated. But you want to target a 1:2 risk to reward. And like I said earlier in the first example, you can even hold your trade until it hits the next key level as long as price action and the candles are telling you to do so. So now let's play this out and see what happens. This is a tough trade to hold, I acknowledge that. And in this case, what option contract would you take? You would take the $85 puts. And like I said, always go 2 days out minimum, but take Friday's expiration. If you're trading on Monday, Tuesday, or Wednesday, and even up until Thursday, you can take the same week Friday expiration. But starting on Friday, you wouldn't take that Friday expiration if you're new to trading options. Just be mindful. Let's continue to play this out. And you can see you hit your 1:2 risk to reward target. It even continued further to play out for you. At this point, once it hits your target, if you want to continue to hold this trade, you would not want price to come back and reclaim this area, because then there's a chance it would then reverse and reclaim the previous day's low. So we can continue to play this out. You can see that price came into this area and you would have gotten stopped out and you're just taking your profits. This is an example of why you should just observe how the trade is working out in your favor. This is a trade where I will be aggressively taking my profits, and if I have an opportunity to have a contract, one contract that could run risk-free, then I will do so. But the way this candle's played out, it wasn't as strong as the first example where you just saw green candles with lots of strength as it moved into your key level. This one had some strength and some indecision candles in the mix. So in this instance, do not overstay your welcome. Thank you so much for watching. Please leave a like and subscribe to the channel. I will see you on the next video.